Hello, everybody. Chris Martinson here, and today we're going to be talking about finance and economics as part of Finance U. Remember, anything that you see in this video and all resources available at our websites or affiliated websites are not intended as or construed as financial advice. This is for educational purposes. Remember, if you have a financial decision, please consult a financial professional. We are not attorneys, we're not CPAs, we are not financial managers. As well, we do our best to be accurate, and everything we represent is as accurate as we know it to be. Now, let's turn to our program. I'm glad we're both smiling and laughing because obviously there's a lot of things not to laugh about. This past week, here we are. It is October 19th here in 2023. And obviously a lot of things going on in the Middle East, all sorts of markets busting a move. You know, the thing my metaphor for this is I hear the creaking and popping sounds like you might hear as a superstructure is under strain, right? And so
Yes.
I wanted to discuss today with people what it means that we're seeing the 10-year U.S. Treasury note bust such a serious move. I'd like to give that some context. I think this is more serious than people understand. And I'm worried that it's going to get a little out of control. That's going to force the Federal Reserve to do something dumb, like, stop me if you've heard this before, print more money.
Yeah.
And create more inflation and pardon my French, but screw the little people with inflation so they can save their big banker buddies from any more profit losses and from the downsides of the policy errors that the Federal Reserve has given us. People need to know about this, Paul, because this really shapes our lives. And it's a small cabal, I use that word carefully, of unelected officials who think they're smarter than markets, deciding that we needed zero interest rates for all those years. That was the monetary vandalism that sets the stage for the catastrophe that I think is coming. And I just want to talk about that because people need to be prepared. And I know you help them financially with that.
Yes. Yes. And if this is the event where everything gets out of control, then there's both going to be a lot of chaos and a lot of opportunity that's going to rise. So it's not absolutely the end of the world. Sorry about that. My phone went off. It's not the end of the world for the people who are prepared, looking at this with eyes wide open, and make the adaptations necessary to protect themselves during a period of time where there's no conservative way to protect yourself against extreme inflation and bond chaos.
Yeah. Now, one of my key phrases that I said back in when I made the crash course first in 2008 was I said, the next 20 years are going to be completely unlike the last 20 years. And that's
Yeah.
a mountaintop. There were a number of things that sit down to make the firmament of that structure. But one of them was this idea that, we're humans. So we have this recency bias, and everybody alive, formed their impression of how the markets work during a very unusual period of time, which is when interest rates were constantly falling. And so that's how the world works, right? Now, I've been listening to the book on tape, incredible book about money. And this guy made a really great point, Paul. He said, look, if you grew up in the Great Depression, that's how the world works to you. You understand that's your framing, and you have a completely different metaphor of money than somebody who grew up in a high inflationary environment, right? And they're both right. They're both lived, felt experiences of money that then shape how you see the world, right? And so for the person in a high inflation environment, you just think, well, I shouldn't hold on to money. Debt is my friend. There's a lot of things you would do, right? Similarly, somebody who's figuring out how the world works when constantly falling interest rates were the norm, that's a very different world than one where they are going up.
Yes, it is.
But the point of the book was that's how you form your worldview, and it's really hard to break out of that worldview once you have it, right? Like you'll keep trying to force fit your investments into that framework. And so the idea is how can we become nimble and understand that has changed. The world's just different.
Yes. And it's going to take an open-mindedness and a recognition of our recency bias, that mental weakness that we have in our human wetware, to be able to be adaptive enough going forward. And as you talk about that, it reminds me, my grandfather lived through the Great Depression, and he talked about that all the time. He hated debt. He abhorred debt. I have a lot of clients, especially in the baby boomer generation, who still kind of make fun of their parents for their unwillingness to embrace debt the way that the baby boomer generation has. But again, if you look at these cycles that are coming through, if we're moving back into that period of time where this debt becomes a problem, then that's a mindset that the large majority of especially politicians have no clue how to deal with, because there's no concern whatsoever coming out of Washington D.C. right now about the level of our debt or the trajectory that our debt is upon.
Indeed. So let me go there real quick. I'm just going to share my screen here. Hope I share the right one. It would probably be this one. Yeah. And then I'm going to supersize this. Ding. Are you seeing what I'm seeing?
I can.
All right, 10-year bust move. So this is the chart I wanted to discuss. This is the US 10-year yield, right? So you can see it's in there's two channel lines. So for people who are maybe just listening and not watching, we're looking at a chart of the 10-year. It goes way back. It's historical. And it starts from 1984-ish. But there's a big moment there where in 1986, interest rates were falling, and then they went back up, and then they hit the top of this channel, and then they went back down and hit the bottom of the channel, then back up. Oh no, interest rates are going up, and sort of get near the top of that channel, and then back down to the bottom, top, bottom, seesaw, boop, 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 all the way down until now. You can see starting there in 2022, something really different happened. It busted out of this 40-year-old channel, and it's busted out convincingly. So, Paul, from a chart standpoint, what do you make of this?
From a chart standpoint, you have to look at that when we talk about that recency bias. So, especially with computer algorithms, technical analysis, trading from a bond standpoint, what individuals will do is when you get to the top of that range, they're going to bet that rates are going to go down. So, and you can see that, that 2019 move raised that bar just a little bit, but you can see you get close to the top and you go down and you hit that lower level, and then they assume that rates are going to work their way back up, kind of like that pendulum swinging on your trend down. But when you have a break of a long-term established trend channel like that, that tells us that hindsight bias and the expectation that a recency bias and the expectation that rates are going to go back down, people moved against that, and that puts a lot of people on the wrong side of the table. That's one of the reasons why we're seeing banks that have so many losses in their long-term treasuries right now, is no one expected this to happen because they've not seen it since 1986, and they assumed that we were going to continue to see more of the same. So this is a breaking the glass moment where everything in the past we have to assume is changed. Now, that doesn't mean we won't have rates come down in the short run, but it's a high probability that channel is going to go up in the other direction for the next 20 years, because interest rates are cyclical throughout history. You have periods of high rates, you have periods of low rates. People are foolish about that debt. And I'll tell you, I was thinking a lot yesterday with that new 100 billion here and 100 billion there, and how fast our national debt is rising. It's like, with the foolishness of our politicians out there right now, why in the world do you want to tie your money up for 20 or 30 years? Maybe the big institutions are realizing that we have a change in this regime now. We have a change in interest rates, and they're much more cautious about 30-year mortgages while we're over 8% at this point. They need to be compensated for that long-term inflationary risk. So this is a dramatic change for pensions, for individual investors, and it's going to take a much different mindset going forward to be successful over the next 20 years.
Well, sure. Now, two things I want to point out, because again, this is the recency bias, but the recency is 40 years. You can't be faulted for thinking that 40 years is a trend, and this is just how the world works, right?
Right.
And you made a second point, which I want to underscore here, which is like, well, it's kind of funny how they drew that top line. Here's how I would have drawn that top line. And I think we had a head fake there in 2018 where let me get my laser pointer out so we can track along here for anybody watching this. This right here, this is where it busted out of that trend line as I would have drawn it the first time. Because you see the way I'm drawing it here, we're just hitting the tops, right? It's a much more coherent trend line. So this was a head fake. They happen all the time. This was the drive down. Now, this is 0.5% on 10 years. I've marked it with this arrow, but it didn't make it back down to the bottom trend line, which would have actually, if it had gone all the way, would have been in negative territory, which is where Europe was, right? At that time, 2019, It was in negative territory, but US 10-year didn't get there. And then, so this was the head fake. This was the thing that suckered in, include everybody, including all those big sophisticated banks. And
Yeah.
this is the destruction of this line right here. For anybody listening, I'm pointing to this line shooting upwards for the yield. That's where that 800 billion, $700 billion of unrealized losses on bank balance sheets is sitting. That's what you've been told about. There's equivalent losses in endowments, pension funds, anybody else who was forced on a fiduciary standpoint to invest over a fiduciary time frame. They all got hammered by this. So that's how I
Well,
would have drawn that top trend line there.
the one thing I want to point out, and I'm glad that you had that trend line in, because that's how I had it drawn, and others that I follow. I don't know that the 2018-19 breakout was necessarily a head fake. What I would consider that, Chris, is that was the breakout that lit the fuse for where we are today. The problem is you had, once you had that indication we broke out, everybody's like, oh, this is a fake breakout when we came back into that trend channel, and you had intermediate term forces that caused it to go lower. But that was your first warning of a trend change. And that's one thing the markets will do from time to time. You may have a breakdown below support that looks like a head fake, or what they would call a bear trap. You think the market's going to melt down. You get this rally that lasts for 6 or 12 months.
Mm-hmm.
Collapse through that level later. So the market tends to give us a warning, before, and especially in interest rates, it's going to be a longer warning, because rates historically move a little bit slower and bond investors a little more patient.
Yeah. This is, I can't draw on here. All I got is a laser pointer. But this to me, let me bring that back on. This to me is like a classic, perfect inverted head and shoulders. This is a
Oh, absolutely.
classic chart pattern, isn't it?
It is. It really
Head,
is.
head and shoulders in a breakdown through the shoulder tells you got a brand. It's a new game until something changes that.
Well, the interesting thing right now is the narrative on in the markets and in Wall Street, and every professional investor advisor that I talk to, is there's no way interest rates are going to continue to go higher. There's no way they're going to continue to go higher. Now,
Right.
I will say it looks like this run is a little overstretched, but the question is are investors finally saying enough? Are we going to have the Fed chairman come out and say, Washington, you've got to rein in your spending? Will he do that? I don't know. And maybe, is the rest of the world, we've got China, who's had to sell some of their treasuries recently to defend their currency. So we don't know when this run will stop, but it's a good indication that things have changed, and they've changed from a long-term standpoint.
Yep. So and to that idea though, Paul, the people are like, wow, they can't go higher, or they won't, right? I think they're just speaking the recency bias. They're like, wait, shouldn't these things keep going down? That's what's always happened. So I'm not sure that's a very sophisticated view. I don't think it's fundamentally sustainable, because I took the liberty this morning to just pull out. I went to US Debt to the Penny, one of my favorite websites. I can't wait for them to pull that data series down, because it's so useful. I can't believe the Treasury Department still releases it, but this is showing U.S. federal debt total on the top line, which is composed of two components, which is intragovernmental holdings, which is a fancy way of saying the rated Social Security piggy bank, and total public debt outstanding is a function of that, plus debt held by the public. This is the Treasury market. So everybody's been talking lately, Paul, about this last little boost right here. It's extraordinary.
Yeah.
It's a really big boost, but I want to put it in context. I've drawn two lines on here. It's actually the same line. It might not look like it, but this line here, which shows that I don't think anything that's happened of late takes us off of the trend substantially. It's just that we were held flat for all that time because of that so-called debt ceiling, and then this is the rebound to make up for lost time. But what I see on this chart, two things. First, that since 2020, this is the trend. I think I could make an argument we're maybe slightly above trend, but not that much. And this is the same line. I know optically it's an optical illusion, it looks like, but this is the same slope. This one over here isn't steeper. I just took this one, copy pasted, and dragged it over just to show that whole rate at which we were going broke as a country from 2013 to 2020 was a very much lower slope than this one. It's like whatever we're doing now, it's like we have a whole new regime, which happened courtesy of COVID, gave the US government this idea that that this is we can just do this now. Like,
Right.
it's not like we've been deficit spending for decades and this is a continuation. It's like, no, we were, and we've really dialed that game up a little.
And it's taken ever more stimulus for less and less impact economically. So um, that's a good illustration you put together, Chris. I like that.
Well, thanks. So I ran a few numbers. So I said, since the debt ceiling's been raised, it's $1.8 trillion. It's been 134 days since that moment, which was back in June of this year. So that's days expressed in years. That's 36% of a year, 36.7% of a year.
Mm-hmm.
So if I annualize that this slope, if that slope continues, if that's the new regime and we're not just on this trend,
Mm-hmm.
and I'm not saying that's what's going to happen, but I'm just playing with some numbers. If that trend continues, right, it implies that we're on a yearly run rate of almost $5 trillion of debt accumulation. That's what the past 134 days of debt accumulation annualizes out to.
Well, that
right?
puts perspective. That really does. That's
insane. I mean, it's $603 billion just over the past month, though, right? So it's been 134 days, which is how many months is that? Four plus, right?
yeah.
And so we should have maybe worked off some of that pent up, energy, like all that pent up borrowing. What is 600 billion over the past month? What does that mean? And I broke it down. Well, there's 3,200 hours in 134 days. So that means it's been increasing at $566 million per hour.
Goodness.
That's how much our federal debt's been increasing. But if we said, well, even government doesn't work 24 hours a day. So if we said, well, an 8-hour working day, there's 1,072 working hours in 134 days. That means the government's been deficit spending at $1.7 billion per working hour, or roughly $13.6 billion per day over this over the entire time since the debt ceiling's been raised.
Goodness gracious. Well, that really puts it into perspective, Chris. And the only thing that I can think of as you're sharing that is, who was it said, how do you go bankrupt slowly and then all at once? It's moving at that pace. It's absolutely unsustainable.
How does anybody justify this in Washington? We just had Janet Yellen come out and say, oh, we can afford 2 wars. Like, no, Janet, we can't even afford 1 war, because when you can afford something, it means you can pay for it.
Right.
There's no affording in here. $13.6 billion per day, $1.7 billion per working hour.
Right. Yeah.
No, Janet, we can't afford this.
No, we cannot afford it. We cannot afford it. And, and when you look at one thing that's interesting is, I think we were talking about earlier, we've heard a lot about real rates lately. Have you heard kind of real rates in the news media and kind of financial publication? Which all those are is market rates adjusted for the effects of inflation. Okay. So for example, since September, and I know this is government stated inflation statistics. You and I both know that the inflation statistics are higher than that. And so do those listening out there when they go to the grocery store, they try to purchase a car, they have to repair something. But from a government standpoint, real rates are positive now. So for example, since September of last year, the stated inflation rate has been 3.7%. The 1-year treasury is yielding 5.4. The 2-year treasury is yielding 5.1. And the 10-year treasury is yielding approximately 4.9. So, at this current trajectory, if it stays this way, safer assets are earning a real positive yield, which is greater than inflation. And that's a big change from the 2017 to 22 timeframe. Well, when we go back and take a look at the data that you just shared, I read a really good article, a guy by the name of Peter Cheer of Academy of Securities pointed out that the real story about rates right now is that DC is driving the bond market rates. So, when we look at what the Fed's been saying, yes, they've been saying higher for longer. Okay. But the market has in late August was pricing in a 70% chance of a hike in November. Well, that's recently dropped to 10% because we are starting to see some deterioration in economic numbers. The consumer's holding up really surprisingly well. It makes me wonder if the consumer is as unafraid of debt when you look at credit card debt as what our politicians are. But that since dropped to 10% now. So the market's not necessarily projecting that the Fed has to raise rates. Now, the probability of a hike in December is fluctuated between 30 and 55%. So the question that we have to ask, and this is a question he asked in the article, is why then has the 30-year Treasury gone from 3.8% in July to 5% in October? The 10-year has gone from 4% in July to 4.9 in the same period of time, with surprising moves to the upside, and that has to be something other than the Fed. So the question is the market trying to take the punch bowl away right now? And yeah, so there's very little concern, as I mentioned before, about Washington and the trajectory of our debt. Nobody's talking about that at all. And, the increasing supply of treasuries being issued to fund the spending and the interest expense on the existing debt is extremely concerning, absolutely concerning. So, to me, when you really look at it, he's got a very good point that this isn't the Fed, it's the politicians. And the question is, if the Fed's serious about, stamping out inflation, are they going to let Washington do the work for them? And at what point is the Fed going to step in and publicly state, you politicians have to get your spending under control? And if the Fed and Yellen are working together, Yellen doesn't seem to be interested in that at all, because she thinks she has a blank line of credit with the rest of the world.
Yep. I'm pulling something up here because I'm going to make a quick case here, which is that I don't think the Fed actually sets the rates. I think they do, but I think they follow. So let me pull this up real quick. And it is this data series here. So I just had to quick slap a thing together. So I'm tracking two things here. One is it's the Fed funds rate. That's this thing in blue.
Yes.
And the second is the market yield of the U.S. 2-year Treasury, right? And I don't know how easy this is going to see, but this is the red line is the 2-year. It rises first, then the Fed funds rate comes up. Let me just stop with, I don't know why it's giving me all these overlays. Let me just zero in here on a more recent thing. I think you can make a case that it goes up first, the red line goes up first, and then the blue line follows it. Same thing. The red line starts falling, and then the blue line follows it. So the Fed, as long as the 2-year rate is rising, I'm convinced the Fed is either going to hold or continue to raise rates. Because they follow. They don't lead. Most people think the Fed does this. No, the markets goes first, or the market's projecting what the Fed's about to do, and the Fed's, got a leaky container, and it accidentally tells Wall Street what it's up to, which is a possibility.
Right.
Alternatively, the 2-year, well, at any rate, the 2-year gives me, that's what I follow first. So when people are like, what do you think the Fed's going to do? I just go look at the 2-year to the Fed funds rate. and right now the 2-year is it came down a bit and it's still going up. And so until that falls, I'm not too worried about the Fed cutting rates.
Right. Yeah, and the 2-year is at a new high now. Again, here just yesterday and today.
Yeah.
Very good point. I believe that you're right on that, Chris. There's been an argument out there for some time. So so the market maybe taking the punch bowl away. But in addition to that, we're starting to see some things, you've been talking about the creaking and popping, and that has continued, and it's continued to get louder. So one of the carry trades, you and I talked about the yen carry trade before. The very aggressive hot money has been using the Mexican peso as the yen carry, is the carry trade. Well, that's starting to come apart now. There's some intervention taking place, continuing to take place in Japan right now. And then you've had China that's had to intervene in their currency markets at this moment in time. Those are important tremors to pay attention to, because they're an indication that we can have a market earthquake here in the interim period. So I'm kind of curious what the Fed's going to do. Is the Fed going to come out and they're going to, be very dovish? Or are they going to stay hawkish? Or are they going to, the next move, may not be cutting rates? I'm curious to see what they're going to do in the midst of these rates going higher, if they're going to do, like you said, and follow the market and raise rates.
Yeah, I'm trying to pull up a yen here just to see where we're standing at. It's on my other computer.
Yeah, I've got the yen on
all I have All I have are the futures, which doesn't help. I can't convert 0.0067 into units very quickly without a calculator.
And I don't have the yen chart on this on the computer that I'm sitting at here. So
Yeah, so but they've been fighting this battle just for to remind everybody, they've been fighting this battle to keep it from going over 150. I don't know why that's a line in the sand, but it seems to be. And to fight that battle, what do you have to do when your currency is weakening? Well, you have to buy that currency. Well, buy it with what? Well, they're buying it with dollars.
mhm.
Where do they get the dollars? Oh, they're holding on to US treasuries in their reserve balances. So they have to sell the US treasury, take the US dollar receipts, take those dollars, use those to buy their own currency, sell the dollar. So that's what they've been doing. So that's why I think it's another pressure on the 10-year rate or even any of the other interest maturity dates, because that's what Japan has to sell to keep their currency in line.
And that's very bad for risk assets if it does come apart, because that means you've got to liquidate the risk assets in the US to pay off the loans that you have over there to limit your losses. So, you and I have been talking about this potentially being the danger zone, late July through the end of October. And we've had plenty of fireworks that have taken place here. Of course, nobody could anticipate what's taking place in Israel and that breaking out. But when our country is in a weak position and our economy is in a weak position, it sure makes it a lot easier for those enemies to make the moves that they otherwise wouldn't make. You don't go after somebody after they're rested and strong in the morning. You go after them after they're weak and both mentally and physically after a long, hard day.
Yeah. By the way, I did calculate. That's why I was a little distracted, but that was 0.0067 is 149
Okay.
To the dollar. So they're holding, they're fighting, but that's a creaking and popping sound because I watched them intervene, and the interventions last but for hours now. And I'm seeing that same thing, Paul. I'm a believer that we have interventions in our equity markets constantly at this point in time. And we have them because it's never a good time to have a down cycle, or we wouldn't want the markets to send the wrong impression, like that wars are bad for the future or potentially, or anything, whatever those mistaken things are that the narrative police really want to not have telegraphed out there. So that's all fine. And I've been watching these and I've gotten used to them, and they hardly even make me mad anymore. Sometimes they do, but I see these interventions. And to me, the turning point, though, creaking, popping sound, is when those interventions no longer hold, right? So there was a big intervention right on that evening when on Saturday Hamas attacked Israel, right? And starting on that first futures open on Sunday night, what did we see? Stock futures up, bonds bought, right?
Mm-hmm.
And oil down and gold down.
Mm-hmm.
That's the holy quadrumvirate of the market. Oh no, everything's fine. Look, if things weren't fine, oil would be going up and gold would be popping and stocks would be down. Everything's fine. And of course, but that only lasted like a week.
Right.
Normally, Paul, when I see those interventions, they throw so much in there because they're a little panicky, and their position is we'd better overdo it. Like they just oversalt the steak.
Yes,
Might as well. Uh, Normally those last a month to 2 months. That only lasted a week.
it did. And especially with yields going up and gold breaking out of some of these negative trend lines, gold's showing an unbelievable amount of strength with the efforts that are being, both the market forces and the efforts of those working behind the scenes.
Yeah.
Um, it's an interesting time. It's an interesting time. And for those who are patient, stay focused on the long term, and are adaptive and courageous enough to not just stick their head in the sand, which is not any of your followers, Chris, then they're not going to come through this perfect, but they're going to be able to navigate it to put themselves in a better position so that they're not wiped out, with the herds from the foolish leaders that we have out there right now and the
Well,
dishonest.
hello, Chris Martinson. I'm the CEO of Peak Prosperity and also Peak Financial Investing. And after watching that, you're probably wondering, well, what do I do with my money? Look, you both deserve and need somebody who can talk to you about what's really going on in this world, understand the situation as it is, not be steering you towards certain things that don't make sense for you or just keep you in a game that's already ended. Look, if you want to talk to somebody about the petrodollar declining, or what is happening with gold, or which sectors are actually the best ones to be in, given what the Federal Reserve is up to or the federal government, you deserve to talk to somebody who can answer those and has a few gray hairs and has been there through some of the economic cycles because, hey, we're in another economic cycle. So it's good to have that experience. Fortunately, at Peak Financial Investing, what we do is we go out and we scour and we look for the very best firms out there who satisfy one thing above all else. They've got great experience coupled to great customer service. So if you want to come by peakfinancialinvesting.com, there's a very simple form you can fill out, just a few fields. You hit send. What happens is an email gets triggered out. It goes to an endorsed firm of ours. You will get an email back. You can then set up a phone call for a 30 to 45 minute free, no obligation, no pressure call to find out if this firm is a good fit for you and to find out if you're a good fit for the firm. It has to go both ways. And if all that matches up, this will be one of the best things that could happen to you this year. So please come by peakfinancialinvesting.com. Very simple process. We would love to help you if we can. Thanks very much.